Accrual and matching concepts. In this lesson, we will look at the accrual concept underpinning financial accounting. This concept is key to understanding the difference between the income statement and the statement of cash flows. We will look at the IFRS rules that govern when firms are permitted to recognise that a sale has taken place, and they can recognise the revenue from the sale in the income statement. We will look at some of the ways that firms may try to manipulate their profits by circumventing these revenue recognition rules. Not all expenses can be readily matched against revenues. In such cases, they are recognised on a periodic basis when incurred. In Lesson 9, we will explore how certain period costs can be transformed into product costs using full costing methods. Session aims. In this session, you will learn formally about accrual and matching concepts. We will build upon the work in looking at accrual principle when we looked at the income statement. You will also learn about revenue recognition issues, ways in which management may try to manipulate or circumvent revenue recognition rules to manipulate earnings. And finally, we'll look at the difference between product and period costs and how they're reported. Unintended learning outcomes. One of the most important goals of financial accounting is that of producing a meaningful period profit. And here we're defining profit as the increase in the wealth of the owners of the firm. So key goals: produce meaningful values for period profit. Most business-to-business transactions are done in credit terms, so companies have inputs, raw material services that they have consumed but not yet paid for, and revenues from sales where they have yet to be paid. These must be brought together for profit to have meaning. Financial accounting is sometimes referred to as accrual or accrual-based accounting. Accrual accounting is the recording of revenue when earned and expenses when incurred. This accounting is recorded irrespective of on which any associated cash flows occur. So the accrual principle, more formally, revenue should be recognised when earned, irrespective of when paid for. Expenses should be recognised when incurred, irrespective of when paid for. Tax accounting differs from accrual accounting in that it gives more weight to cash when costs are actually paid for and revenues received. A company may report a profit for a period based on accrual accounting, but be unable to pay taxes on these profits because it has yet to be paid for the goods that it has sold. It would make no sense for governments to tax firms on this basis. Financial accounting is sometimes referred to as accrual or accrual basis accounting. The accrual concept gives rise to the matching principle, which aims to combine related cash flows from different points in time in order to calculate a more meaningful profit for a period than one based on when cash actually changes hands. IFRS revenue recognition requirements. The accrual principle states that revenues should be recognised in the period in which they are earned, but does not specify what earned means. At what point can a firm recognise revenue as having been earned? When they have received an irrevocable order, when the goods or services have been delivered, when they are invoiced, when they are paid for. IFRS has laid down the following revenue recognition requirements that companies must meet to determine when revenue can be considered as earned and hence recognised, taken through the income statement. There are two principal conditions. The first is that the rights to all economic benefits from a product or a service and responsibilities for any risks have been transferred from the seller to the buyer without recourse. The buyer cannot return goods to the seller without good cause, or in the case of retail sales, that returns can be reliably estimated. The second condition is that the amount of revenue and its associated costs can be measured reliably. If a firm cannot measure reliably its associated costs, then it cannot calculate a meaningful profit figure for the transaction. If not all of the costs associated with the sale are recognised, it would allow firms to overstate their profit for the transaction. There are two additional conditions which must be met in the case of goods. The first is that delivery of the goods has to have taken place, and the second is that legal ownership, the title to the goods, has passed from the seller to the buyer. The recognition of revenue is regardless of when payment is received. Sales may be made on credit terms, paid for in cash on delivery, or paid for in advance. Invoice credit sales. The most common business-to-business sale involves an invoice credit sale. Revenues from sales made on credit and that have been invoiced but not yet paid are recorded under accounts receivable. The value of this account gives the total amount of all outstanding customer invoices. The value of each transaction is reversed when payment is made. Some services are billed for in arrears, so credit sales that have not been billed. Some services, electricity as an example, may be used by the customer before the supplier invoices the customer. Accrued revenues or accrued income represents the value of services that have been delivered to customers that have not yet been invoiced. These are current assets. When invoices are subsequently raised and the customer is billed, accrued revenues are transferred to accounts receivable. Accrued income as a line item is normally only seen at service companies providing long-term services under contract to their customers, which are billed for in arrears. Cash sales. Cash sales are taken directly through to the cash accounts in the statement of financial position. These normally include sales to customers made using debit cards where payment is virtually instantaneous. There is usually a short delay in receipt of the cash from credit card sales as the transactions are processed. As these are due from a financial institution rather than a customer, these are recorded as a current asset under due from banks and may even be reported under cash and cash equivalents rather than accounts receivable. And finally, customers may pay for some services in advance. If a customer pays for goods and services in advance, the cash received is recorded on the asset side with a matching entry under current liabilities recorded under unearned or deferred income. Many businesses are paid for their services and goods by their customers before the firm delivers them. Airlines provide one obvious example where people buy tickets sometime before they are due to travel. The airline records the cash received on the asset side of the statement of financial position, and an equal amount is recorded as a liability under deferred income or unearned income. When the passenger actually takes the flight, revenue is taken through the income statement, the value recorded under deferred income is reversed, and the difference, ignoring taxes, is taken through as profit to equity. From the customer's perspective, these advance payments result in prepayment assets. Examples of other firms with a relatively high level of advance sales are hotels, other leisure and transportation companies, and insurance companies. The matching principle and expense recognition. We've looked at revenue recognition issues. When should expenses be recognized? When they are incurred, when they are paid for, when the associated revenues are recognized? How should we deal with costs that cannot be easily associated with revenues, such as those of the head office and other administrative expenses? In its broadest sense, the matching principle is that, to the extent possible, expenses should be matched to the revenues that they have helped to generate. The matching principle is closely related to the accrual principle, which concerns the recognition of revenue and expenses based on the economic substance of transactions rather than when they're actually paid for. It is not always possible to match all costs with a specific sale. The consequence is that costs are recognized in one of two ways, dependent on whether or not it is possible. When it is possible, costs are matched against their associated revenues, product costs. Recognition of these expenses is therefore driven largely by revenue recognition considerations. So more formally, costs associated with the revenues should be recognized in the same periods in which the revenues are earned. So what we're doing is we are matching all of the costs that are needed to generate a sale with the revenues from the sale in the same period in which the sale takes place in order to calculate a meaningful figure for gross profit. If we do not have all of the costs at that time, then the profit will be overstated for that period. Corporate overheads are costs which cannot easily be matched against revenues from the sales of goods. These costs are reported under other operating expenses, and examples of such costs may include the following. Head office costs are the cost of the buildings themselves, head office staff, executive management, people working in the finance division, human resources, marketing, the actual marketing costs where they cannot be allocated directly to products, centralized data centers, call centers, and IT networks. And some firms, these costs may be allocated to production units rather than taken as other expenses. But some firms will report these costs as within corporate overheads. And the same occurs in terms of distribution and selling costs. So warehouses, distribution centers, transportation, and stores. Some firms report these costs as corporate overheads. Some allocate these costs to the firm's manufacturing overheads, where they become part of the manufacturing overheads and are then treated as period costs. IFRS does not dictate where these costs are reported. Expenses are recognised when the service is received or cost incurred, irrespective of when paid for. There are 4 ways in which expenses may be paid for. The first is paid for in arrears and bills. Costs which are recognised in one period but will be paid for in a future period and for which the firm has been invoiced are recorded under accounts payable as a current liability. Then we have expenses paid for in arrears and estimated. Costs which are recognised in one period but will be paid for in a future period and for which the firm has not yet received an invoice are said to be accrued. The company estimates the cost of the services it has consumed, for example, electricity for the head office, and these are taken through the income statement, and the estimated payment outstanding is recorded under accruals or accrued expenses. Some expenses may be paid for in cash, and finally, some services may be paid for in advance. This is the other side of unearned income. These are called prepayments or prepaid expenses. A specific example of a prepayment might be the rent paid in advance on a property. Only the portion of the period in which the firm has the use of the premises would be taken as expenses through the income statement. Any balance left over, paid for but not yet used, will be recorded as a current asset. And finally, we'll look at the application of the accrual principle to the use of non-current assets. It would not make sense to take all of the costs of non-current assets, property, plant and equipment at the time they're purchased. If we did so, this would violate the accrual principle, which is recognizing the costs when we receive the benefits from using them. We started to look at depreciation when we started looking at non-current assets. This is a process whereby the using up of non-current assets is reflected in the valuation of the assets on the balance sheet. The depreciation process is used to take the effective costs of them through the income statement by matching the costs to the periods in which they are used. We will look at depreciation of non-current assets in the next lesson. So in this lesson, we've looked at the accrual and matching concepts or principles, revenue recognition issues, and product and period costs.